Hello, everyone. In this session, I am going to discuss money and banking. That is chapter number 8. And you can see on your screen as well. So, let me read out these learning objectives. So, these are the three learning objectives we are trying to achieve in this chapter. Number one, describe the functions, characteristics, and history of money. So, what I'm going to do in this session, I am going to discuss the functions uh, of money. We also discuss very briefly characteristics, and then I ask you to read history of money from your textbook, which I'm going to give, tell you the exact page numbers. Second objective is explain what is and is not money and describe the main function of modern banks as money lenders. So we'll discuss this. And finally, explain how a small amount of cash can support many loans and create more money. So in the last objective, we try to understand the money creation process by the banking system, that is all banks together. So let's start first with the functions of money. So there are basically three important functions. So money serves as medium of exchange, a store of value, and unit of account. So these are the three functions of money. The most important one out of these three is the first one, that is medium of exchange. Money is an intermediary that can be used to make purchases or to make transactions. So money is used as medium of exchange. It avoids the inconvenience of a barter system. So for example, if I want to buy a cell phone, then I will go to the shop and buy this cell phone by giving money. And another person who wants to buy a laptop, then that person will go to Best Buy, for example, give money and buy laptop. If there were no money in the system, then I will have to find someone who is willing to accept my cell phone, and I am also willing to accept his or her laptop. You're getting my point. So you have to have what we call double coincidence of wants. By double coincidence of want, I mean that yeah, the double coincidence of want. I mean that two people must have uh, they should demand the product that you are willing to give, and you also should demand the product that he or she is willing to give to you. Then trade will take place. So money will actually serve this purpose, that is medium of exchange. So where you can use money and make purchases easily. Store of value. By store of value, first read this slide and then I'll tell you. Just give me a second. I have one. Okay. So by store of value, uh, it allows transfer of purchasing power from present to future. That is, basically, you can store value in the form of money. I know because of inflation, it's risky that if you give money in the form of cash in your home and then use after 5 years, so the purchasing power of your money will be much less compared to 5 years ago because of the inflation. But still, you can store value in terms of money. So wealth can also be stored in other forms. That is why I'm saying that nowadays, we don't keep the cash as a store of value. We can, invest in bonds, stocks, and buy real estate as well. Some people also keep money in the form of gold. So these forms are not liquid and involve more risk as well. This is the problem. Yes, you can keep value for a longer period of time by purchasing a real estate, an apartment, for example. But if you need the cash in emergencies, would be close to impossible to sell your apartment in one day. So that is the apartment would not be considered as money because that apartment, yes, serves the purpose of the second function, that is store of value, but it does not serve the first purpose, that is medium of exchange. So you cannot buy goods and services using your apartment. And medium of exchange, remember I told you that it avoids or it solves the problem of double coincidence of wants. So that is important. So you don't need double coincidence of coincidence, sorry, of wants. The third function is unit of account. By unit of account, I mean that using your money, you can value each product easily. So if you go to the Walmart or to Superstore or to Best Buy or to Costco or to any other mall or stores or retail stores, you will see each product has a specific price tag. So what is that price tag? Price tag is in terms of dollars, in terms of money. So we are actually valuing each goods and services in terms of that product, that is money. So you never see that the price of one refrigerator is two washing machines, and the price of two washing machines is one cooking range. So you are not valuing one commodity in terms of another commodity, like in barter system. You are actually giving value in terms of money. So it's much easier to value goods and services. And it also you can also record debts using that money and also make calculations. It's much easier for calculation if you have dollar terms for all those goods and services. So these are the important three functions of money that you must remember. These are some of the characteristics of money. Because when you read, let me first go here. So this is history of money. So these are the 3 pages that you have to read from your textbook. And so this is just the history of money. By history of money, I mean you have to understand how the concept of money actually developed over the years. Now, how do we decide which product is considered as money? Why not I just assume that sofa is money and we purchase everything with the sofa? That is, why not? That is theoretically possible. So actually, when we develop such an instrument that is used as money, we have to understand that instrument should have certain characteristics. Some of them are given here. Number one, acceptable. So for example, if I print these notes in my house, those currency notes will not be accepted. So it has to be accepted. When it is acceptable, it means that a central authority in the country will actually provide those instruments. So paper currency notes are printed by Bank of Canada, right? No one else can print. So that is one important characteristic. Second, it is durable as well. So sofa cannot be used as money because it's not durable. So after 50 years, there's a wear and tear, and you will not have even sofa or 100 years. So that is another important characteristic, that it has to be durable. And you must have seen that now we have plastic currency notes and durable. So durability is also very important. Portable as well. The problem with the sofa, I know it's ridiculous and funny as well. The problem with sofa is it is not portable. So I can't take sofa to Costco and buy, meat. That's not possible. So that is another important characteristics that should be portable. So in the past, people used different products like gold um, as money, because but even there is an issue of carrying gold, because it has weight and it is not as portable as it should be. Divisible is also very, very important. So I cannot say that a cow is considered as money, because cow is not divisible. Similarly, sofa is also not divisible. So I can't say, okay, just give me 1/4 of sofa and I'll give you in return this product. That's not possible. So it should be divisible, standardized. That is easily recognized but not easily copied. So, so far there are so many different types of sofas. It's very difficult to produce this product, standardized product. It's not impossible, but it is difficult. And of course, but not easily copied as well. And then finally, as I told you when I discussed this acceptability of the currency, that it should be controlled by the central authority. Here, in our case, is Bank of Canada. So even if you want to read more, you have to read the textbook, or you can just Google and you will have all these definitions. So there's no point wasting time here. Now, these are different types of money over the years. Okay, so this is basically the development of this concept, that is money. So first, we used to have commodity money. By commodity money, I mean any commodity is taken as money. For example, gold coin. Remember, when I say commodity money, I mean that the intrinsic value, is equal to face value. This is the meaning of basically commodity money. What does this mean? It means, suppose if I have a gold coin, let's say the worth of this, the face value of this gold coin is, suppose, $10. Let's assume $10. If this is a commodity money, it means that if I sell this coin as a gold, then I will also get $10 in return, because this coin has gold worth of $10. So even if I use as money or as a commodity, it doesn't make any difference. So the gold content in this coin is same as the face value. So face value is face value. Intrinsic value is actually the value of the gold contained in this coin. That is what we call commodity money. So the value, intrinsic and face value, both are equal. Then we have coins. Although I have given you the example of gold coin, but this is a commodity money. Then we have coins. In coins, the only difference is that still I have a coin, still it says $10. But the problem is, if you sell this coin as a commodity, then you are not going to even get 5 cents, because now this coin is made up of nickel, uh, copper, zinc. So with these three, inputs, we actually make these coins. So the intrinsic value of these coins are nothing, but the face value is $10. So if you use as a money, that will say, okay, this is $10. So if intrinsic value is less than face value, we call this type of money as fiat money. So by fiat money, you can use as a money, that's fine. But if you can use as a commodity, you're not going to get any return or any money against this. Paper money, same example, same as coin. Paper money, this is a paper money of $100 bill. So this is $100 bill. If you sell this $100 bill as a piece of paper, you will not get anything, zero. But if you use as a money, it says this paper has a value of $100. So that is fiat money. That is, the face value is much higher than intrinsic value. And then you have a very new definition, that not definition, this is a new type, checkbook money. This is also called bank deposits. So if I have a checking account and if I have $300 in my checking account, that is also used as money using my checkbook. So these are four types of, there are others as well. Now come to, so that's all as far as, so we discussed so far just three things. Number one, these are the three functions of money: medium of exchange that avoids the double coincidence of wants, a store of value that it allows transfer of purchasing power from present to future, and unit of account, that is, it measures the value of each goods and services. Then we talked about these characteristics of money, and then we talked about uh, types of money. You have to read history of money. Now, this is what we call fractional reserve banking. What is fractional reserve banking? So this is a method of banking in Canada and across the globe. What is fractional reserve banking? So we'll discuss in a moment, but see this word. It says fractional reserve. That is, banks will use fraction of their total reserves in their vaults with them, and the remaining money or the remaining reserves will be used to make more money. That is the meaning of fractional reserve banking. Let me read this out and then we will discuss. So modern banks do not act, and we all know, simply as big safety deposit boxes. So when you deposit your money, so they are not, this is not their purpose to just keep your money safe, guarding depositors' money until they require it. That is not the purpose of a bank and all of these banks. People usually write checks and don't take out the actual cash currency most of the time. I'm not saying that they are not going to withdraw cash. Sometimes I go to banks and also my bank and also withdraw $100, $200, $300 cash. And all these banks, commercial banks, they do have some cash with them in their drawer. So if anyone comes, then they can easily give that amount. But not all of depositor will go to the bank and withdraw their all money in the form of cash. So they keep, by they I mean the banking system, all these banks, they keep a fraction back in case the depositor comes to withdraw it. So believe me, if CIBC in one city, if all depositors at the same time reach the bank and say, okay, we want to withdraw our money, bank won't be able to give you money because bank does not keep your money in the form of cash. Even sometimes if you need a higher amount, you have to first give notice to your banks that you need $50,000. You want to withdraw $50,000. Then the bank say, okay, we will arrange and come either tomorrow or the day after tomorrow, like this. So banks don't keep all cash that you deposit with them. Then, what then banks normally do with that cash or with that reserves, what we call? This leverage allows a greater rate of return for the bank, more interest. So banks actually use your money and lend to other people and earn interest on that money. So if I want to buy a house, I want to apply for a mortgage from, let's say, CIBC. So CIBC will give me money, the depositor's money, and charge 6%, 6.5% interest. So that interest is banks earning. Okay, I think I missed one slide. Just give me a sec. Yeah, so this, okay, that's fine. Now I'll come back to this topic in a moment. But first, the problem is in real life, the problem is, when we discussed medium of exchange and store of unit of account and store of value and unit of account, these are the three main functions of money. So you must have in your mind that by money, I mean currency and coins nowadays, right? So loonies and toonies and $5 bill, $10 bill, all this. But if I ask you, do you think the cash, the money that I deposited in my checking account is also money? Because I can, it serves the purpose of medium of exchange. Because if I need money, I can easily use that money, either using my debit card or just go to the bank, withdraw, and then make purchases. So it is, what you call, it is liquid. So I can use. What about if I have money in my savings account? What about if I invested my money in mutual funds? Why not? Because it is possible. Of course, it's not 100% liquid, but if I need that money, then I will request the mutual fund company to return my money. If there's some restriction, they might charge you some fee, whatever, but I'll get my money back maybe in 1 week. So after 1 week, I have that money in my hands for transaction. So what I'm basically trying to tell you, that you have different forms of money that have different liquidity period. So currency, that is paper notes or currency notes, and coins, these two are 100% liquid. So if I have $100 in my wallet, I don't have to go anywhere. I can go directly to the shop and buy. That is 100% liquid. Checking account is very close to 100% because I have debit card. I can use real quick, like cash. But saving accounts, you can't use debit card for savings account. So first thing, either you go to the bank, withdraw that saving money from your saving account, or you can go online and transfer your money from saving to checking and then use your debit card. That is possible, but it takes a little longer than in case of currency and coins. So what we do now normally, we then define money in different categories. So these are some of the categories that are given here. But remember, all of these definitions uh, serve one purpose, that is medium of exchange. So anything widely accepted as a medium of exchange to buy goods or to settle debts. But the problem is of timing. Some of them are really liquid, some of them are less liquid. So uh, economists have actually defined, there are so many other definitions as well, but we stick to these four. So you have to just, I don't know, memorize it. So first definition of money, this is what we call M1 supply of money. And this is the term that we use. Okay, hold on, let me first, okay. So this is M1. What is M1 supply of money? M1 supply of money is currency in circulation. So, some people are buying goods and services, paying in cash. So currency is also in circulation. Sometimes I use also currency, not all the time debit or credit cards. So if we calculate currency in calculation in the whole country, and we also calculate all checking accounts, that is, we call it demand deposits. So all checking accounts, because you can use checking accounts as well, using your debit card. So this is like currency basically. So if we add all these currency in circulation and demand deposit, checking account, where you have different banks. So you must have all these accounts with the chartered banks. There are other banks as well, which we call them near bank or quasi banks, like servers. So we don't include in this definition accounts with the servers. That is a credit union. We'll discuss in a moment. So If we calculate M1 supply of money, so what we do, we just calculate currency in circulation. Remember, currency in circulation and demand deposit and currency in your checking accounts. If we add, this is called money supply, M1 supply of money. This is most liquid form of money supply. Then we go further and we define M2. What is M2? M2 includes M1 as well, always. So these two are already added, but we add another term, and that is notice and personal term deposit, once again, of all chartered banks, in chartered banks only. Okay. What are notice and personal term deposits? Personal term deposit means you have account with the bank, and you normally it is a term deposit. So you actually save for 6 months, and let's say maybe you are earning interest, so you can't withdraw money before 6 months. So that is the problem. This is not like checking account that whenever you want you can withdraw. Notice deposit is you can withdraw, but you have to give a notice to the bank before you withdraw money. So if you have money in these types of account, and if you add this as well, we call it M2 supply of money. Definitely, M2 supply of money is more than M1 supply of money because you have added money in these accounts. Then we have M2 plus. This definition of money, that is M2 plus supply of money, is M2. Remember, this plus is not this plus. Remember this. This is M2 plus definition, and we are adding M2 and then add plus deposits at near banks. Near banks means all those financial institutions that are not defined under Bank Act. So, for example, credit unions, for example, trust companies, for example, mortgage and loan associations. So, all these are not defined under the Bank Act. If you add accounts as well to M2 definition of money, then you have M2 plus definition of money. Then we have M2 plus plus definition. What is M2 plus plus? You have M2 plus and you further add Canada saving bonds and mutual funds. Suppose you invested in mutual funds $5,000. That $5,000 will also be added because that is also money. But of course, you cannot use right away, but you can use. It serves the purpose of medium of exchange. So in this course, we will only stick to these four types of money supply: M1, M2, M2 plus, and M2 plus plus. But later in this chapter, I will be only working with this M1 supply of money. So don't worry about M2, M2 plus, and M2 plus plus, but you should know at least these definitions. Now, I have one, I believe, test on understanding slide here. Yeah. So this is the example. I don't have to go through because you know these formulas. Just plug numbers and find the answers. So suppose this is the data in billions of dollars, Canadian dollars. So coins, $13 billion, deposits at near banks, 337, demand deposits, $72 billion, Canada savings bond, and non-money market mutual funds, that is 320. So although, we are not going to discuss this, normally we discuss these topics in personal finance course, but by non-money market, I mean long term. Money market means short term investment. So you are basically investing in slightly long term mutual funds, right? Because it's very short term, then that is liquid as well. Why not we add it to M1 definition? That is why I'm saying this is non-market, non-money market mutual funds. Money markets investment are for short period of time. And then notice and personal term deposit, $215 billion. Notes, by notes I mean paper currency, or currency notes. That is $17 billion. What you have to do, you have to calculate M1, M2, M2 plus, M2 plus plus. And these are so M1 is $112 billion, M2 327. I've already given you the formulas, right? All these, what you have to add. So in order to calculate M1, you have to add coins and notes. Why? Because currency. And then plus demand deposit. And for M2 plus and M2 plus plus, these are the variables that you have to, basically, these are the accounts that you have to add. So this is, I know this is not the recent data. I think this is in 2019, if I'm not wrong. So look at this. This is for the Canadian economy. Look at this. The role of currency is just $90 billion in our currency. Demand deposit is $907 billion. So if we add $90 billion and $907 billion, that is the money supply, M1 supply of money in our country. Then you have $819 billion further, and then 480, and then 238. So this is the composition of all these four money supply definitions. In developing countries, the role of currency is much higher. Why? Because banking system is not well developed there. So people don't trust normally, and they would rather, make transaction using cash. Now, important is, I said during this session so many words. Number one, I said chartered banks, then I said near banks or credit unions or mortgage companies, all this. So here are some of these definitions. Number one, chartered banks. So all Canadian commercial banks which have received charters under the Bank Act, Big Six. So these are the six commercial banks. I am 100% sure that you know all five of them. So I just wrote the sixth one, National Bank. But you know all those five: CIBC, Scotia, RBC, TD, and BMO, I believe. No, Scotia. Yeah, BMO, I believe. Okay, but you can check in the textbook. Other institutions came into existence because banks were originally forbidden to provide certain types of loans. So earlier, if you want to apply for a mortgage, banks are not basically allowed to to provide mortgages. That was the reason we have other financial companies uh, come into the market. But nowadays, banks are actually providing all sort of services as other financial companies are providing. So all those financial institutions other than commercial banks, we call them near banks or non-bank financial intermediaries. These near banks include credit unions, trust companies, mortgage and loan associations. All these intermediaries, all these institutions are not defined under the Bank Act. So what is the difference? The difference is, if you have deposited money in one of these six commercial banks, then your money is insured under CDIC, and it is insured, I think, up to, I don't remember, so I don't want to say any number. But here, these are not insured. This is the difference. Okay. Then I said demand deposit, notice deposit, personal term deposit. I've already explained, it's also written here as well. So demand deposits, depositors can demand their deposits in cash anytime, same as checking accounts. So basically by demand deposit, I mean checking accounts. Notice deposits, depositor need to give notice to the bank before making a withdrawal. This is non-checkable deposits, same as a savings account. And then personal term deposit for a specific term, such as 6 months. So if you have invested your money with the bank for 1 year, that is basically your term deposit. So you can't withdraw before a year. But you can definitely, but you have to pay the penalty, or I don't know, some fee. Now, what is not money? We already discussed money. What is not money? So number one, that is most important, currency in the worlds or tills of banks. Remember, when I defined M1 supply of money, I said currency. I did not say currency. I said currency in circulation. This is currency that is lying in the vaults or tills of these commercial banks. We don't count them. Why? Because, for example, if I go to the bank with my $100 and I deposited $100, the teller actually takes that $100 in her or his drawer. That $100 is a cash currency. We don't include in everyone's supply of money. Why? Because that $100 is already reflected in my checking account on my record. So if you are adding my checking account as $100, why you are counting that $100 that is in the drawer again? So basically you are double counting. So we don't count all currency in the vaults or tills of banks. Gold is also not considered money. Why? Because gold serves two purposes. Number one, yes, you can keep gold for a longer period of time, and we can use gold as well as a unit of account as well. But gold is not, is not used as a medium of exchange. It's not easily converted into goods and services. And in some economies, if sometimes it's illegal, right, to go and try to buy something from gold. Financial securities, stocks and bonds, checks, credit cards, debit cards. Remember, I just said that checking account or demand deposit is a part of money supply. M1 equal to currency plus demand deposit. But what I'm saying, debit cards and these checks, they are not money. Why? Because these are simply means of accessing money. So, for example, if you have debit card in your wallet, that debit card itself is not money. Why? Because suppose if you have $0 in your checking account, you that card doesn't mean anything. If you go and shop anything using that debit card, you will not be able to buy anything. So that card is nothing. The money that is in your checking account is important. So debit card is just a way to access your money that is lying in your checking account. Now, financial institutions have one thing in common. And by financial institutions, I mean all commercial banks and near banks. That is credit unions, trust companies, mortgage and loan associations. So these are all, they have all one thing in common. And let's read this. They are intermediaries. By intermediaries means they are actually working, connecting people, right? So they are actually serving as a middleman and act as agents among households, businesses, and governments that have funds available for lending and others who want to borrow those funds. So if I deposit my money in my savings account, or if I deposit my money in GICs by GICs, basically I'm lending my money, and I bank is giving me, let's say, 3.5% interest. Then bank will use that money and find some borrower, and bank lend those borrowers that money at a higher interest rate, 6% interest rate. So this gap between 3.5 and 6, this is the what we call spread, and this spread is the earning of bank. So if the spread is large, bank will be more than happy to lend money, and of course accept money from us at a lower rate and then give at a higher rate. Now this is the last topic of this chapter, creating money. So banking system will create money, and that is why I wrote on the top, if you read, banks can neither create nor destroy currency. So I'm not talking about currency. Currency means paper, note, and coin. So I'm not saying that CIBC can just steer all those dollar bills, $100 bills, and put in the trash and say, see, there's no money, destroy the money. This is not what I'm saying. Banks can create or destroy loans and checking accounts. And I'll show you how. But before going to understand that what is the money creation process, how money is created, remember, I told you that we are now going to stick to this definition, M1. That is currency plus demand deposit. Bank cannot do with this currency. Currency means notes and coins. Bank can change these demand deposits, checking accounts, by giving more loans. And so money supply, that is amount supply of money, will increase even without printing any new money. Okay, let's see how it will work. But before going to do this, we have to understand this simple balance sheet of a typical bank. So those of you who have studied accounting, they know as well, more than me even. So we have asset side of the balance sheet. That is what a company owns or what others owe it. Okay, that is assets. So if bank is lending money to others, that is a bank's asset. If bank buys computers, that is bank's asset. Okay, liability, what a company owes to others. So for example, if I deposited $10,000 in my checking account, then this is bank's liability. When I go and demand my money, then bank will have to pay me that amount back. So that is the bank's liability, because bank owes this amount to me. What is net worth? Net worth is simply total assets minus total liabilities. And this is also called equity. So the difference between these two is also called equity. By equity, I mean this is the bank's own assets. Okay. Now let's take a simple okay, so we have already discussed this. What is, so let me read this. I don't know how to explain this because I've already explained it except the last term. Bank profits make most of their profits from interest on loans. Spread, I just discussed this. The difference between the interest rate a bank charges borrowers, which is pretty high, and the rate it pays saver, which is low. And this is what we call the difference between these two rates is called spread. Now we discuss this. This is very important. Target reserve ratio. What do we mean by target reserve ratio? So each bank is required. I'm not saying that this is what Canada is practicing. This is not what I'm saying. I'm going to discuss both theoretically, and then I'll discuss what actually Bank of Canada and the banking system in Canada they are doing. So banks are required to keep certain fraction of the total reserve with them. So let me give you a simple example on the same page. Suppose if a specific bank or typical bank does not have any account at all, zero account. And now suppose if I go there and I deposited $1,000. Now bank will not keep this $1,000 in their vaults or tills. Why? Because bank wants to make money. So bank is not just your custodian of your money. Bank wants to make more money. So the central banks or central bank, sorry, or central banks of all these nations, they sometimes control. Why I said sometime, because in some countries they are not controlling as far as reserve ratio is concerned, which we'll discuss in later chapters. So let me put this way. I don't want to say something confusing and also that can be not true in all cases. So suppose if I deposited this $1,000, if this bank, this typical bank, let's say keeps $100 in their tills, just $100 cash, that in case I go back and withdraw money, then they can give me up to $100 right away. If I ask more money, then they will say, okay, we don't have enough cash with us, so please come tomorrow and we will arrange. Arrange from where? Arrange from another bank. So this $100 is what? Is 10% of this $1,000. So basically what I'm saying, that each bank is required to keep this 10% dollar in the form of reserves, cash. This is called target reserve ratio. That this is always in percentage. So see this, the fraction of deposits that a bank wants to hold in cash. So all banks will hold a certain amount of cash, and that is called target reserve ratio. That is, they cannot use that money for whatever reason. So they can't lend out that money. They have to keep this money with them all the time. Why? Because depositors can come and withdraw. Now, once you know this target reserve ratio, so this is again explained here. I just give you the example here. So let me write here so that you know what I was telling earlier. Suppose if I deposited $1,000, and suppose if the target reserve ratio, let's say, is 10%, that is, this bank is required to keep 10% of this deposit in the form of cash reserves. So 10% of 1,000 is 100. So target reserves will be $100. So this $100 must be with the bank in the form of cash. Okay. Now let's take one example. So this is the Seymour Bank. So first one example. So this is the Seymour Bank. So first consider the all assets and then all liabilities. So see what is happening actually with this bank. So I start from this bank has total deposits of $100,000. So there are so many depositors who have actually deposited up to $100,000, not up to exactly $100,000 in the form of demand deposits. So this is this bank's liability. This bank will have to return this money, okay, $100,000. Now, the moment bank has this deposit, what bank will do? This bank first keep certain percentage in the form of cash. This is what we call reserves. So now you can see this bank is keeping reserves of $10,000. So I can easily calculate percentage. So $10,000 and this is $100,000. So this is 10%. This is what I have shown you here. So 10,000 divided by 100,000. That is actual reserve right now. The bank has this currency, cash, and divided by total demand deposit, 10%. So 10% is actual reserve. Although in this slide it's not given even by the publisher, but I'm telling you that this 10% is actually target reserve, not actual reserve, target reserve. How do I know? Let's discuss further. So now see what this Seymour Bank is doing. Seymour Bank has this $100,000. Then Seymour Bank keeps this $10,000, and then the remaining $90,000, this bank will do business and make money. So first, this bank will give $60,000 to different customers in the form of loan, mortgage, personal loan, whatever, house or car loan, whatever loans. So provide this 60,000 is gone in loans. Now, since these are the loans to customers, right? This is the bank's asset, because others, all these customers owe this amount to this bank. So this is bank's asset, 60,000. And then banks also invested some of this money. That is remaining $30,000 is invested where? Buying stocks, bonds, mutual funds, wherever. Bank also invest money. Why they are investing? Make money. So they are making money. So notice that 60 and 30, $90, $1,000 is invested in the form of giving out loans and in securities. Bank has only $90,000 because 10,000 is in the form of required reserve or target reserve. So target reserve is 10,000. That's why I said target reserve, because there's no excess reserve. They have to keep, not they actually, this bank has to keep $10,000 in reserves, 60,000 loans, securities, 30,000. What is this then? 20,000. 20,000 is basically owner's equity. That by owner's equity, no, I mean basically those who own this bank, that is shareholders. So this is the fixed asset, computers, tables, papers, printer, all this stuff. That is, let's say, 20,000. So if you add all these numbers, you get 120. This is demand deposit, and this is shareholders equity. How do I calculate it? 120,000 minus 100,000. That is assets minus liabilities. So this is their ownership, 20,000. And the total is again 120. So both are equal. So right now the situation is pretty clear. I haven't talked about any money supply creation process. I just explained that if you deposit money with a bank, then bank will take your money, keep certain percentage as reserve, and then the remaining amount will be loaned out to customers in order to earn interest. Okay. Now let's see what would happen if so. Uh, I will come back to this in a moment. Okay. Now, if there's a new deposit of $1,000, so suppose if I go to this same bank and deposit another additional $1,000, what would happen? Now see what would happen. First thing, that the deposit will increase from 100,000 to 101,000. I just added 1,000 to 100,000. Then this 100 additional $1,000, this additional $1,000 will come here in the reserve. Why? Reserve means cash basically. So now they have 1,000 additional cash. Earlier they had 10,000, if you remember. Now they have 11,000 cash. So they have 11,000 cash, and the demand deposit rate 101,000. Okay, that is 100,000. Yeah. So this is 101,000. Okay. So 101,000, and now your reserves are 11,000. You must notice one thing, that if I calculate the 10% of this number, because this bank is required to keep 10% of the total demand deposit, but I'm sure that this 11,000 is not 10% of 101, that is 101,000. So what is 10%? So I will show you in the next slide and see what is happening here. So see this, and I'll go step by step, and I try to speak slowly as well. Total reserves, 10% of this 100, this number, 10% of this number is 10,100. 10,100. That is not total, that is target reserve. That is, bank must, this amount must be held by the bank. So bank must keep this amount 10,100 at all times. So this is your target reserve. How do I calculate this? I calculated this target reserve by taking this new demand deposit, overall new deposit, and then I take the 10% because I know target reserve ratio is 10%. So I get 10,100. But notice, we have reserve which is not 10,100. It's more than 10,100. It means we have excess reserve, more than the required or target reserve. How do I calculate? This 11,000 minus this required. This is what I've done this here. So what I've done here, excess reserves equal 11,000, that is this actual reserve, minus 10,100, that is this required. So we have additional or excess $900. So the moment I deposited $1,000 with this bank will keep $100 in their reserve. Why? Because the 10% of 1,000 is $100. That is why the required reserve is now 10,100, and the remaining $900 will be used for what? For making more money, for giving this to other customers at 6-7% interest rate. Okay. Now let's see what would happen, what this bank will do with this additional or excess reserve, that is 900, what would happen? Let's see this. And this is just an example, but in real life, it happens actually. So this is written what I just said. Banks use excess reserves to make loans. Loans are eventually deposited, creating new money. So, for example, if I uh, buy a house and I apply for mortgage to, let's say, from TD Bank, and TD Bank, let's say, approves my application and says, okay, you are approved of, let's say, $300,000. And then I will pay a check of $300 to the owner of that house from whom I am actually buying. So the owner is not going to withdraw all $300,000 in a briefcase and bring that money in his or her house. The owner will probably, most likely, if owner does not have a bank account with the same bank, then owner will deposit that same amount in another bank, in his own bank. So money is not going anywhere. Money is actually moving from one bank either to the other bank or even to the same bank as well. So if owner has a same bank account with the TD bank, then that amount will be electronically transferred from my account to owner's account. So this is what they are saying, that loans are eventually deposited, creating new money. So demand deposit will increase. And this process will continue until no more excess reserves. Now, what is the process? Let's discuss this. And hopefully this is the last two slides. Now see, so we started, and remember this, we started first that suppose Tom deposited $100. Now I'm not talking about what was the initial demand deposit with the bank, maybe 100,000, maybe $5 million, maybe $10 million. Number one. Number two, I just want to make one comment real quick. When I show you this budget, this balance of payment, remember these are not the only listing in the balance sheet of a bank. These are only for this course, so that you understand. So don't think that balance sheet just has these three components. Okay. So Tom, suppose, deposited. Sorry, hold on a second. So Tom deposited $100, $1,000. What would happen? This bank now has 1,000 extra cash, that is reserves. So this bank has 1,000 extra reserve, not excess, extra. Then this bank will keep 10% of this reserve in the form of cash or reserve. So 100, but 900 this bank can loan out. So this bank will give $900 to Winky, a customer of this bank. So this Wing actually receives this $900 as a loan. And then suppose Wing deposit has the same has an account with the same bank. So Wing actually deposited this $900 to, okay, not this bank, to New Star. I don't know what is New Star. Read the textbook. It is from the textbook, right? So actually, Wing, maybe she, I don't know, he or she, maybe may want to buy something from, let's say, a refrigerator from the New Star shop. So Wing paid $900 to this shop. Then this shop has account with the same bank. So this shop deposited $900 in the same bank. So the bank has $900 increase in deposit once again. What will do this bank again? This bank will keep 10% of it, which is $90, and $810 will be loaned out again. See, will be loaned out again. And when this 810 is given to Sue, then Sue actually gives this $800 to Sarjeet. Sabjit has suppose account with another bank, let's say. So this is also increase in the form of demand deposit, because Sajid also some deposited this amount in the bank. If any of these, that is Winky or Sue or Sabjis, if they don't deposit this money that they receive in their respective banks, then the process will stop. Process will not continue. So then this 800 bank will again keep 10% and the remaining 729 as loan. So see what is happening. And I'm telling you, I'm writing here. Initially, I just deposited just $1,000. I mean Tom. So Tom deposited initially just $1,000. So this was the increase in demand deposit initially, $1,000. Then this increase will initially increase the reserve by $1,000. Okay, and then this 1,000 reserve will again increase the demand deposit by $900, then $810, then $729. So see what is happening. Every time I'm reducing 10%, because 10% is the target reserve ratio. So if I continue and if I add all these numbers, then I get 10,000. How do I know that I'll get 10,000? There's a formula. There's a formula to calculate this number. So let me show you what is that formula. So this is the formula. Let me first write this. So first, So initially you started with 1,000, and then you have 900, and then you have 810, and then 7, whatever, I don't remember. 7, okay, let me check. 7 what? 729, okay. 729, right? So the rule is that first take the initial number, that is 1,000, and then divide this number by 0.1. Why 0.1? Because 0.1 is 10%. 10% is written as 0.1. So 10,000 divided by 0.1 is what? 1,000 divided by 10%. 10% is written as 0.1. So 10,000 divided by 0.1 is what? 1,000 divided by 0.1 is 10,000. This is what I wrote earlier. Now I showed you how to calculate this. Now let me be more specific and more formal. So see this first. First, we need to know what is money multiplier. In chapter 7, if you remember, we talked about multiplier, that is 1 over 1 minus marginal propensity to expense, if you remember. Now we have money multiplier. This is not expenditure multiplier. This is money multiplier. What is money multiplier? First, let me read this. The increase in total deposits, overall deposit, that would occur in the whole banking system, not necessarily with only one bank, as a result of a new deposit in a single bank. That is, if you remember, in the single bank, deposit was increased by only 1,000 initially, but the increase in total deposit would be 10,000. So it means when deposit increases by 1,000, the total deposit increases by the multiple of 10. Multiple of 10. This is what we call multiplier. How do we calculate the value of multiplier? So the formula is so easy here. Money multiplier, the formula is 1 over target reserve ratio. That is 1 over 0.1. 1 over 0.1 is 10. So multiplier is 10. You can see when demand deposit increases by 1,000, just multiply by 10 and you get 10,000. This is what I said. So instead of multiplying by 10, I divided by 0.1. That is the same thing. So don't get confused. So this is the formula that you have to remember. Change in deposits equal to money multiplier times change in reserves. If you remember, initially the change in reserve was $1,000 initially. When Tom deposited $1,000, reserve increases by $1,000. And then I use money multiplier 10%. So 1 over 10% is 10. And then if you multiply 10 by 1000, you get the total change in deposit. Not 1000, but 10,000. Although initially Tom just deposited $1,000, but because of this whole process, loan creation process, the total money supply, that is M1 supply of money, there's no change in currency, but there are more demand deposits. So everyone is saying that I have money. I'm getting my point, and the money is same. So, for example, I also say, oh yeah, I have in my checking account $500. The person who actually borrowed this money also say, yeah, I have $500 in my accounts. I can use and make payments. It doesn't matter whether he owns that money, he or she owns that money, or she borrows that money, or he borrows that money. It doesn't matter. So money supply will increase. Now, the bigger the target reserve ratio, the smaller the money multiplier, sorry. The smaller the target reserve ratio, the bigger the money multiplier. I can just give you one example and it will be clear. So I'm writing here, for 10%, if the target reserve ratio is 10%, what is the value of multiplier? So I'm writing multiplier as MU. Okay, multiplier is 1 over 0.1. This is a formula, 1 over target reserve ratio, but in always write in decimal point, not 10. So that is 10. So when multiplier is target reserve ratio is 10, multiplier is also 10. Okay, now let's take target reserve ratio is 20%. What would happen? When target reserve ratio is 20%, the value of multiplier is 1 over 0.2. 0.2 is 20. So that is only 5. So see what is happening. When target reserve ratio increases, multiplier decreases. The value of multiplier decreases. So if more and more, if target reserve ratio is really very high, then the value of multiplier is very low. Why? Because higher target reserve ratio means that bank will have to keep higher proportion of the demand deposit in the form of reserves. So they can't lend out money. If they can't, give loans, then money supply will not be created that much. And that is the reason why you have lower money multiplier. So if target reserve ratio is 10%, then initial increase in demand deposit will increase the total deposit 10 times. But if target reserve ratio is 20, then yes, initial increase in demand deposit will definitely increase total deposit, but only by 5 times, because banks are holding more money in the form of cash. So they are not using for generating more income or generating more checking accounts. So that is all as far as chapter number 8 is concerned. So we talked about functions and characteristics of money, types of money, and the fractional banking system, what is and is not money, main function of banks as a money lender. We haven't discussed this, so you have to read. So what are the functions of what function of banks as main function of banks as I think we discussed, because don't worry about this. This is basically, it meant basically that banks are using that excess reserve to lend. Okay. And how money is created through deposits and lending. So remember that bank will create money by just give me a second. Okay, just give me a second. Or my system is I don't know what happened. Yeah, okay, it's working. So how money is created through deposits and lending. So we have just seen that if depositors deposit money, then that money is used for lending, and that will create more deposits. That is what we call money creation process. So that's all as far as chapter number 8 is concerned. Make sure you go through practice questions on your course website, and just take care. Bye bye.